Okay, let's make sure you guys can hear all right. Does it sound okay up here in this part of the world? You guys okay? So. Do you want a bit more? Want a bit more? Okay. How's that? Is that better? Or is it, yeah? Okay. What about you guys at the back? You okay? It looks like a nod. What about you guys down here? You okay? Yeah? Okay, so let's make a start. I do have one administrative announcement, is that the third online quiz actually is the first week of the second term, so it's like still 4 weeks away. But seeing how this is the last week, it covers all the material from the overview up to the end of the stock market. So the stuff we're starting today on the derivatives is not in that quiz. I'll give you some more details on the quiz later this week. So it covers everything from the overview through to the end of the equity markets. So today we start derivatives. Unfortunately, this is when the 2 terms are 6 weeks long. This is the beginning of term 2. So because it normally takes 5 lectures to do this, so that means we're going to have 4 this term and then a long gap and finally finish it next term. But we'll just have to cope with that. So today we start the derivative markets. Now, it's fair to say that many people in the world have some vague ideas of what they are. Some people have heard of them. A lot of people have never heard of them. But they tend to hold a particular fascination for finance students, and indeed the derivatives course at third year is one of our most popular third-year course. And one of the things that tends to attract people to derivatives is these stories of how many millions of dollars people can make trading, well, billions of dollars trading these things. And fairly soon I'll show you some huge losses to sort of motivate our interest in them. But it's fair to say, even within the financial sector, there's a lot of people who don't understand how they work. And in fact, one of the big losses I'll show you, when the guy was taken to court, he said, "I didn't actually understand what I was doing, sir." Dumb. And also in New Zealand, there were some cases over some swaps, and the bank staff who was selling them said, "Well, we actually didn't understand what it was we were selling. We were just told to sell them, so we did our job." So let's look at an outline. Things actually split into 2 pieces. There's this section here on the forwards and the futures, and then there's a second set of slides on the options and the swaps. So we're going to start off with these cautionary tales, how people lose these money. Then ask what are they, and then sort of ask where did they come from. And then we'll get into the details of the markets, the spot and the forward market, and then the futures contracts, how they're used, and a little bit around the regulation. So looking at this list now, these are some of the, well, in fact, the top 3 are the 3 largest losses in history in terms of uses of derivatives. But if you split that into 2 pieces, there are, in fact, 8 different companies or entities there. The top 4 are definitely financial institutions. Like you can see, I actually changed that, so if you got the old slides, Sumitomo was in there. I've tossed Sumitomo out and put long-term capital management there. But 2 hedge funds and 2 in banking. So they're definitely financial institutions. But then the bottom 4 are things that you might think, well, what are they doing? Because Orange County and Hammersmith and Fulham, they're both local bodies, not that dissimilar to, you say, Canterbury Regional Council or the Christchurch City Council, and yet they managed to lose an awful lot of money. Orange County, $1.7 billion, and in fact, there's a nice book written about them called Big Bets Gone Bad, and the author here actually lived in Orange County, and he's a professor of finance there. So he basically details what actually went wrong with this particular, well, it's just a municipality, and how they came to lose all this money. So when you're thinking of the top ones, the financial institutions, this is actually part of their business, okay? So if we're thinking about the amount of money they lost, we cannot make the argument that they should not have been engaging in this type of trade. This is simply part of their business. And, this is what some of the, services that they provide to their clients. Now, one might argue that if they lost that much money, they didn't run their business very well. I mean, that's a fair argument. But you can't say they shouldn't have been doing it. Okay. This is just part and parcel of the business that they ran. Now, the lower ones, because they're not financial industries, it's very hard to initially think, why on earth would they be doing this? And in fact, when you see some of the numbers that are associated with them, like this is some stuff from the Hammersmith and Fulham one. Let me grab this thing here. Their bacon was saved by the British courts. So, I don't know if you can read that very well, but it says, British court ruled last week that the interest rate swap contracts arranged by a local government in London were not legal. So they got their bacon saved. So this number over here, 600 million, is a little bit of a guess of about what they would have lost had they not had their bacon saved by the court. And it says here, according to the High Court, this Hammersmith and Fulham Council did not have legal authority to enter into dozens of contracts totaling about $9.5 billion. Okay, $9.5 billion worth of contracts. Scroll down here, and summary of the court's findings had an annual budget that's supposed to be a pound sign, 280 million pounds. 280 million pounds, that's their annual budget. They entered into $9.5 billion US worth of contracts. What on earth are these guys doing? Now, there's a question about whether that ruling extended to the rest of the sector, and this estimate here. If the court's opinion was extended to swaps arranged by other local government councils, losses, that would be losses either by the council if they get bailed out, losses by the banks, of another $650 million. So, what on earth are these things? What are we supposed to be doing with them? Let alone what actually are doing with them. What are we supposed to be doing with them? So we're going to ask the question, what are they? One thing I would say about them before we get there, in contrast to the types of instruments we've seen so far, these ones here are primarily about managing risk. And one thing about them, and we'll see this as we go along, is that for most derivatives, swaps are a bit of an exception, that there is no money gained or lost in the derivatives trading. So when you see that Morgan Stanley lost $9 billion and they were really sad about that, there were some very happy traders on the other side that picked up that $9 billion. And so if you think just in just general statistical terms, your expected return by entering into a derivative contract is zero, with one minor exception. There's some transaction costs. So your expected return is zero minus whatever your transaction costs are. So if you do this, you do expect to make a little loss. You don't expect to make money out of it. So the derivatives themselves, this little explanation here probably doesn't make a lot of sense out of context, but as we go along, hopefully this will acquire some meaning. So the derivatives themselves, they're securities or contracts, and the value of the derivative depends on the value of some other asset. And we refer to that asset as either an underlying asset or sometimes simply the underlying. And so if you, say, wrote a derivative on the price of wheat, of whatever form that derivative takes, then the value of the derivative will depend on the value of wheat. So if the value of wheat rose and fell in its wheat market, then the value of the derivative will rise and fall in a very clearly defined manner compared to that price. So what they're used for, or if you use them according to purpose, that is, they are there to adjust your risks. So when we think of the risks that a business might face, often there are two sides to it. There's a good side and a bad side, but those things, although in dollar sense they are exactly equal, in terms of the business they are not equal. Let's take, for example, a dairy exporter, not Fonterra, another one. Dairy exports they're priced in US dollars. So there's two problems that the exporter might face. One is the actual price of that thing might go up and down. Secondly, the actual exchange rate might go up and down, depending on how those things go out in the market. Now, if we think, say, for example, very typical is that they enter into a contract for sale, and then they will ship their goods, and ultimately, say, 3 months or 6 months down the road, they actually receive the payment. And so when they contract for that sale now, they know pretty much how much profit they're going to make. But the problem is they're not going to get their money for, say, 6 months, and say they're exposed to the problem of the exchange rate might move. So there's two problems there. One's actually a good thing. The exchange rate might move in their favor, and in this case, New Zealand dollar chugged down. That would actually improve their profitability. So this is actually really nice. Alternatively, it could move up, and that would be working against them. And it has the potential, if it moved far enough, that not only would they have less and less profit, they might get to the point where they make a loss. So although those two are equal and opposite in dollars, they're not equal and opposite in terms of the company. One would be nice, okay, more profit. Heading into a loss is a risk that they really can't afford to take. So when you're using these things as you're supposed to, in terms of hedging, what you are doing is trading away what would be nice to avoid a risk that you cannot afford to take. That's what it's supposed to be all about. Of course, people use them for all sorts of things, speculating, big time speculation. Who's talking today? Sorry. Okay, so where do these things come from? Like many financial products, they've been around for a very long time. They've been traded intermittently for several thousand years. We've got good evidence of things like forwards for at least 2,500 years. But when we look about where the modern one comes from, they actually come out of the agricultural sector, and they started about 200 years ago. So why things got started is that, if a farmer wanted some working capital to, plow a field, plant it, grow something, they often go down to the bank and say, can I have a loan to tide me through the growing season, which, may be sort of 7-8 months long. And the banker first thing wants to know is, well, how much are you going to get for that, let's say it's wheat. How much you get for the wheat? How much are you going to grow? Now, how much you're going to grow is always sort of a difficult problem because it depends on the weather. And the price, I think, well, they could go look out what it's trading for now. But they're not going to actually get paid for another 6 or 7 or 8 months. And so that price could change. And so you've got uncertainty both in quantity and in dollars. So what they started to do was enter into these things they call forward contracts. And what it allowed the grower to do was fix the price that they would receive at the end of the growing season, say it's 7 months away, fix that price today, so that when they went to their banker, they could show them their futures contract, forward contract, and say, well, I got the contract here, I'm going to get so many dollars and cents per bushel of wheat. And still an uncertainty around how much they're going to actually grow, but then the banker says, well, okay, looks at and either grants the loan or not, as the case may be. Now, to get one of these things to work, what you really need is two people with equal and opposite needs. And if we're taking wheat as an example, a flour miller is a good example of someone with the opposite needs. So the wheat grower will grow the wheat. At the end of the season, he'll have that wheat, and he wants to sell it. So he wants to fix his price today. The miller wants to buy the wheat at the end, grind it up, turn it into flour. And so there's the incentive for them to fix their costs. So you have a natural situation where one person would like to fix the sale price, the other person wants to fix the buy price. And if you can get that to work, you have the basis for a forward contract. You can simply enter into the two sides. Two sides take the opposite bids, and you contract it. And so you have the beginnings of what's recognizably a forward contract. Now the problem in this is, if one of those has pricing power, and in this case, obviously, it would be the miller, and that would mean, like, for example, if the price of wheat went up, he simply puts his price of his flour up. If the price of wheat dropped, then he simply puts the price of his flour down. If he has pricing power, then he has no incentive to engage in this type of contract. So that's when they brought in the middlemen. So there began to be people, the wheeler dealers, the speculators, who started to take positions in these agricultural products. Obviously had no interest in actually buying them at the end, but they would buy them on the anticipation that somehow they'd make a profit, and that as came to time when they say the wheat was going to be delivered, they would actually sell that to someone who actually really needed it. So that's how the things got going. In fact, the world's largest futures market, derivatives market, the CME, started its life as Chicago Egg and Butter Board. That's how it started its life, trading futures on eggs and butter. But then there was a lot of innovation, and 1970s brought the first of the financial products, foreign exchange derivatives and interest rate derivatives. 1980s, stock indexes and options started to be traded. Then 1990s, these things around interest rates here, swaps, options on credit. And then some really interesting ones, hurricanes, futures, and here's some even more recent ones, weather futures and options. These are comparatively recent. So this is high degrees per day. That's what the HDD stands for. And this is basically the deviation of the temperature from the average expected temperature. So you can buy futures on or options on a number of cities in the U.S. and a number of cities in Europe, too. And again, if the other side, the cooling, that's again a deviation from the average temperature. And so if you have some business which is dependent upon this, for example, if you're an electricity generator, people are either using your product to heat or turn the air conditioning on, and you want to hedge that risk, then these things here, that's what they've been introduced to do, to hedge that sort of risk. So if things are hotter than expected, you may have to buy in electricity, but you can hedge that risk with one of these ones here. Again, if it's cold, people are going to heat, and they're using electricity, you may have to buy in electricity. That's a risk, but you can hedge that with one of these as well. So there's still, considerable innovation going on in these markets, and the range and types of products being traded are gradually expanding. Now, how big are these markets? Now, this is an interesting question. It's actually really quite hard to work out because a good chunk of them are these over-the-counter market or the dealer markets, and there's no central exchange that knows exactly who owns what. But the estimate is, from the Bank of International Settlements, is that the derivatives markets nominal value is somewhere between 15 and 20 times the world's GDP. Far out, Nat. And so what I've always been saying about controlling your risk and hedging your risk, in actual fact today, this is what's happening. Some people do manage. Some people manage their risk. But the big thing now is to create risk for the purpose of trading it. That's what they're doing. They are creating risk to trade. Okay, so that's all by way of introduction. Hopefully you found it interesting. So now we're going to move to the first pair of derivatives, the forward and futures. They're very similar, but there are some subtle differences between them. So let's start off. What's the major differences between the spot market, futures market, and forward market? Let's start with the spot market. What's the spot market? Let's take foreign exchange as an example. What would be a spot market for a foreign exchange? Nobody knows. Well, spot market is simply the price you pay for today. So if you want to trade today, you trade on the spot market. So like if you used your credit card and you bought something overseas, say you bought your textbook from Australia, that trade would go through on the spot market. Okay, what about a futures contract? Well, when we talk about foreign exchange, what would a futures contract be? Oh, you're not quiet again. Oh, well. All right, roll there. Next slide. Okay, spot when we said that. Now, the forward contract, these ones are traded in the dealer markets. These are dealer markets, or over-the-counter markets, as we sometimes call them. And the thing about these ones is that they can be customized to meet your needs. So if you're a genuine hedger, say you're an exporter and you have a foreign exchange risk, or you're an importer, foreign exchange risk, and you genuinely want to hedge, really want to hedge that risk, what you normally do is you go to your bank and you enter into a contract, a forward contract, and you simply customize all the details of that contract to suit what you need. So these things, because there's a dealer at the other end of the phone, you talk to them, you can sort out, get pretty much anything you actually need to hedge. And the thing that makes them different from the futures, even though they're basically a future delivery thing, is that the futures are traded on exchange, and so the terms and conditions of the contract are set by the exchange. So they're all nicely standardized. And of course, nicely standardized means they're nice and liquid. You can be traded a lot. Now, for a hedger, you can usually get a pretty good hedge on the exchange, but you can't get a perfect one because they're usually like, if you're talking about foreign exchange, you usually have to deal in, say it's a US dollar. Typical contract size is maybe $100,000 US dollars per contract. So if you're expecting to get, have to pay, $4.1 million dollars or, $4.15 million, you can get pretty much what you'll need, but you can't get it perfectly. Whereas if you went to bank and entered into a forward contract, you can customize it down to the last dollar. There's also some differences around the way these things are priced going forward. Basically, with a forward contract, once you've entered the contract, there's no further cash flows until the end. Whereas if you enter into a futures contract, then there's some cash flows that occur between the start and the end of the contract. And we'll come to exactly how that works later. So there's lots of different assets that these things are traded on. You've seen a bunch of financial ones. There's a lot of agricultural ones still traded, pork bellies, wheat, lumber, all sorts of stuff like that, and commodities such as crude oil and so on. So there's a wide range of things that are covered by these contracts, and as we've seen, you can even get derivatives on the weather, like hurricanes and unusually warm weather and stuff. You can actually buy derivatives on those as well. So there's a wide range of stuff out there that you can trade on. So we're going to take an example now of how these things work. So this is essentially a forward. We'll start to draw how this thing works. So what we start off with, so this is zero value. So this axis here is value, obviously in dollars. And this is an exchange rate. So this is your foreign exchange mark along there. And we'll start one off here soon. Now, this is the quotes that we get. So we ring up our dealer and we ask for some quotes going ahead. And this is what he tells us. If you want to trade today, he's got a bid and an ask. And again, the difference between those two is how this dealer makes his money. And then he gives you, in this case, he gives you 4 different forwards. And what's quite interesting about them, and we'll come to why this is that they systematically are going down. So, if you look at them, both sides, they're systematically going down. Okay. So, in one sense, you can realize, when you see that straight off, you can realize that there must be a very specific way in which these prices set, because they're varying in a very systematic way. And exactly how we set that will actually come to, I think, not until the foreign exchange section, which is the next topic. So bear in mind that there's a very precise way of actually calculating the fair value. And of course, they're not exactly fair because he's got to make his money. So what he will buy them from you is less than what he'll sell them to you. So they're set around a very precise fair value, these rates. So there's a systematic difference there. And so in the example, what we're going to do is we're going to take a 6-month forward in the example that follows. So here it is. This U.S. company has got a commitment to pay 1 million British pounds in 6 months. And we just got that rate there. So this is going to be the rate. So right here, $1.4359. That's the rate today. So they enter into the contract, and so there's 2 sides of the contract, the long side and the short side. Now, in terms of the company and the bank, which of those is going to take the long side of this contract? It's going to take the long side. Long means that you're going to buy the asset at the end of the time. Okay, in this case, the company's going to buy the 1 million British pounds. Okay. So that means they're in the long position. Bank's going to sell it, so they're in the short position. So the payoff from these two things, the long position payoff looks like this. And we'll work out. And this is the company, and we'll make the bank the other country color here. So it should be a straight line. So that's the short position, and in this case, the bank is taking the short position because it's going to sell the British pounds. Now, notice that's 0 there, that's 0 there. And the key point about this is the price is set so that initial value equals 0. That's how the price is set. You've got to work that out so that both the long position and the short position have no value at day 0 when it starts. Now, as soon as the exchange rate moves, okay, either up or down, then those contracts either acquire value or lose value. So if the exchange rate moves up here, so the exchange rate's going up that way, becoming bigger, then the long position, their contracts gain value, the bank's position lose value, but if you add them up, it comes to 0. Okay? Remember I said no money is gained or lost? Here's, in this particular example, you can see any gains on the long position are mirrored by losses on the short position. If we go the other way, go down this direction, any losses on the long position are mirror image on the other side, gains by the short position. Add them up, you get 0. Okay, any questions on it to this point? Foreign exchange. Yeah, okay. We'll get to that in the next topic. FX is foreign exchange. Sorry about that. I should have said that. Okay, any other questions? Okay, so what we'll do is we'll think about what happens to the thing if the exchange rate has moved away in the next 6 months. So we fixed the price here at, it costs us $1.43.59 US cents to buy a pound. That's the contract price. Now, if the thing has gone way over here, okay, so let's say the foreign exchange rate now for this is now at 153 and 59. So exchange rate moved over there, and for the long position, this is the basic deal here. Pays $1.43.59 US per British pound, which is actually worth $101.53.59 per pound. So that ends up, they get it cheap. Okay? They get it cheaper than if they'd waited. And so they have a US 10 cents per pound gain. So if the exchange rate moved up, like it does in this case, companies smiling, save themselves a lot of money. Of course, exact opposite happens on the other side. So if we're down here on this side, in this case, the bank receives $1.43.59 US cents per pound. which is actually in fact worth 153.59 dollars per pound. So they end up with a loss of 10 cents per pound, and that's their loss, because they have to sell it at the contract price, but it's actually worth more than that today. Bad luck for the bank. Okay. Any question on that before we do the other side? Yeah, go ahead.
So when you say, what's the difference between this company buy insurance on the currency exchange?
Well, an insurance is more like an option, okay? And in the second half of this topic, we'll cover options, and options are exactly like buying insurance. This one, in insurance, you claim it if you have damage, but you don't claim it if nothing goes wrong. And an option is like that, whereas this one, you fix the price, and it doesn't matter what happens, you pay that price. So if you're thinking of insurance, options are like insurance. We'll come to options a bit later.
I feel like this one is the default risk premium is supposed to be extremely high.
No, there's no.
Really risky
For who?
for both sides.
Well, if it's a bank, okay, let's say it's big bank,
Yeah.
ANZ, the chances they're going to default on you is next to nothing, and the bank won't enter into the contract unless it's satisfied you're worth it. Okay, so it does its normal credit analysis on you or the company as the potential buyer of the contract, and they won't enter that contract unless they are assured that they pretty safe. And the second thing about it is they've got their bid-ask spread, which makes them a little profit. Okay, so in terms of default risk, the default risk is going to be priced into this bid-ask spread. Okay. Okay. Any other questions? Okay. So let's go the other way. So let's say it tunnels off way over here. So it's going to go down, and now it's at 133.59. That's what it's at now. And so in this case, we'll take the bank first. The bank receives the price that's contracted, 143.59 US dollars per pound. But they're actually only worth 133. So they actually get per pound. So they have a gain there. They get more than the thing's actually worth. And the gain in this particular case, 10 cents, US cents per pound. So in this case, the bank is smiling. Good deal for the bank this time. And of course, the company's on the other side down here. And exactly mirror images is that they pay 143.59 per pound, and that's actually only worth 133.59 per pound, and so they end up with a loss of 10 US cents per pound. Okay. So when you add up the gains and losses, doesn't matter where you are, they all come to zero. This comes to zero. But if you had a genuine risk, and that the risk of going down was something you really couldn't face, you would trade away what would be nice to avoid a risk you can't afford to take. And there's lots and lots of trading going on in the swaps, not the swaps, in the forward market. And one of the things about the forward market is because most of the people that trade there are actually genuinely hedging, almost all of the forward contracts end up with the delivery. Typically, over 90% of forward contracts actually end up with whatever the asset is being delivered as contracted, which is not the case in the futures market. But this is a market for hedgers. Okay, so I've got a nice slide over here that wears all this. So this is all the same stuff. I just drew on my bit of paper. Basically explains that where the gains are made. So if you're, that's your long, there's your gains there, losses there. Short position, gain there, losses there. Which is basically what we drew over there. Okay, any further questions on it before we move on? Yep, go ahead. No, they don't. Typically, if you want to close out your position, you have to go back to the bank and settle. So there's basically, with these ones, there's really no secondary market there. You go back to the dealer that you dealt with if you want to end it. And typically they don't. I mean, 90% plus they go full term, and their delivery occurs as contracted. Very small percentage will get closed out in this particular market. In the futures market, yeah, a lot of closing out.
I feel like this forward contracting that the game theory could apply in this case.
Well, maybe.
One person's gain is based on one person's loss.
Yeah, that's exactly what happens. Yeah, they're exactly mirror images of each other. Yeah. One person's gains, another person's loss. That's exactly right. Yeah. Yeah, do you have another question? Yeah. Yeah, in the forward market, yeah, that's almost everybody who takes one out expects to go to the end, and they will be delivered at the end. Now, it's not the case in the futures market, but in this market it is. And that's why you can. One of the things that's really good about them is if you need something specific, you can customize it right down to the last dollar and cents and the day and everything to meet your needs. So if you have specific needs, then you tend to go into this market rather than into a futures market if you're hedging. Yeah, go ahead.
In the example you use for like hedging and like the market
Oh, yeah. But normally, if you're going to do that, you would actually use the futures. That's just, if you want to speculate, the futures aren't that much different. But that's if you're going to be a speculator, that's where you would trade. In fact, what we see in the futures market is typically around 2% of them actually go all the way full term. Most of them get closed out before they get to the end, simply because it's a different type of trading going. Got another question?
Yeah. Just wondering the reason that for the forward contracts, the shorter the maturity, the risk is higher.
Shorter the maturity, risk is higher.
Yes.
Don't think so. No, shorter.
Because I can see that the price, it's short maturity, then the price is high, definitely higher than the last one. If you've got a year, then the price is definitely lower.
Okay. Yeah. Okay. Why this goes in this systematic way, we will get to that in the foreign exchange market stuff. How this is priced. Okay. So, it's like everything we do in this course. It takes a long time to make everything make sense. So this is, if you think of it this way, these two prices here are closer together than those two prices there. Okay, there's a much bigger gap between the spot and the 1 year than there is between the spot and the 1 month. That's thinking about risk. There's that big gap there. It's the one that you should be looking at, not the actual absolute values of the exchange rates. It should be the difference between today and the future rather than what the actual absolute value of that price is. Okay. Right, moving on. Okay. So what's the basic difference between the futures and the forwards markets? Okay, so in the futures market, forwards customizable. Yeah, they're fixed by exchange, and so what does that tell you about their markets? So the exchange market is more liquid? Yeah, lots more liquid. Lots more trading in the futures market than the forward. Anything else about the structure of those markets? Forward market is a dealer market. Futures markets are exchange markets. So if you were thinking of actually doing this, what's the advantages of using one of them rather than the other? So say for example, if you're thinking of, say, hedging or speculating, either way, on movement in foreign exchange, which of these would you choose if you which of you would choose if you were hedging? Yeah, typically if you're going to hedge, you would use a forward, which means then if you're going to speculate, what would you use? Yeah, you would probably use the futures if you were speculating. Okay. So the uses are I mean, people can hedge with the futures. They can speculate with the forwards, but typically that's not the case. Usually they're quite distinct markets. So let's see. A couple of terms in here. Seller delivers at a specified date, and it's called settlement date. Pretty self-explanatory. But the contract price, and in terms of this one we had here, that's called the strike price. And in the case that we had there, the strike price was here. This $1.43.59. In that example we just looked at, that's the strike price, and that's the price that makes this thing worth zero when it starts. So the banks, big traders in the over-the-counter markets, because they're dealers. Key point there for the futures is that they're standardized. Now, if you think about it, about how this works, when you're in a forward market, both parties know who the other party is because you ring up on the phone and you talk to them. What's the basic problem with trying to go out on an exchange and trade? When you're thinking about what might happen in terms of default. If you're talking to the guy on the phone, and he's at the ANZ, you've got a pretty good idea what the default rate might be with the ANZ. Now, if you're going to trade on exchange, what's your default risk there? What's the chance that you get down to the end of the contract and the guy on the other side says, "Me no pay"? High. Yeah. So there's a way of dealing with this problem. That's sort of listed there. So we'll draw a picture of how this thing works. So because if you trade on an exchange, you actually don't know who you're trading with. There's just a computer that matches you with somebody else. And so the probability of default, you have no idea what it is because you don't even know who you're dealing with. You just put your order in. When the computer matches up, you have no idea who you traded with. So what happens is this. Let's see. So here's the exchange here, sitting in the middle, doing its thing. And there's two traders. We'll put A and B over here. And what will happen is that A wants to go long. We won't put any prices in here. And B wants to go short. And lo and behold, they get matched. So position gets opened. Now, this problem of the default risk is quite real because A has no idea who B is. B has no idea who A is. So what happens is that the contract is immediately shifted over to a thing called the clearinghouse, which actually runs the system. And it shoves itself in the middle. And so what happens here is A still has a long position, but the clearinghouse takes the short position with A. And on the other side, B still has a short position, but he now has it with clearinghouse, and the clearinghouse has a long position with B. So this is there to address the issue of this default risk, because A doesn't know who B is, B doesn't know who A is, you have no idea what the default risk is, and so this process, which we call novation, is to shove a third party in between those two. So the exchange is there just to match the order. Once the order is matched, it's transferred over to the clearinghouse, and the clearinghouse becomes a counterparty to both of them. So if B defaults, the clearinghouse has to handle that. A is fine. If A defaults, clearinghouse has to handle that. B is fine in that case. So A and B don't have to worry about their creditworthiness of the person they're trading with. Now, if you think about whether the clearinghouse has any risk or not, let's draw a basic payoff diagram. So there's their contract price. A was long, so I'll draw in black. Clearinghouse is blue, so it's short. And then on this side over here, have exactly the same thing. Clearinghouse in this case is long, and the trader. So this one's A, and this one's and this one's B here. So the blue ones are the clearinghouse, and because they have a long position and a short position, when you stick them together, add those two together in terms of the clearinghouse itself. So there's the clearinghouse here. It has a short and long, so it has zero price risk. Zero price risk itself. Okay. So in terms of the risks that the clearinghouse face, because it has both contracts, has long and short of exactly the same type, everything about those contracts is identical, they have no price risk. It's nicely hedged out. But what they have is they have a default risk on both sides. They have a default risk with A, they have a default risk with B, and they're going to have to manage that problem. Okay. Any questions on this at this point? Yeah?
The clearinghouse is kind of like intermediary. So A got a default, so they claim against A.
Yeah, and we'll come to exactly how they handle this. But yeah, I mean, it's essentially they shove themselves in. Well, they call it novation. Nova is just means new. So we're just shoving a new party in there. So that's all we've done. That's all we've done. And it's specific to deal with this problem of default risk. That's quite real if you're trading with people you have no idea who they are. Okay, so there's the full picture. Now the futures market, we said before, delivery is seldom made. Almost always, way above 90%. They offset the positions before maturity. And there are plenty of contracts out there, particularly ones on financial things, which they're settled in cash. You don't even if you could deliver, you don't. You pay in cash, and that's particularly on financial contracts. So you don't actually have to deliver them. Now, point we made before, standardization makes them very liquid. So it's very easy to open and close contracts in these markets. But if you really want to hedge, the forward is typically the way to go because you can get exactly what you need there. Now, what are we doing? Running out of time, that's what we're doing. So these are the standard terms: contract size, contract delivery months. Typically, there's like only 4 months of the year when they expire. Last trading day is almost self-explanatory. Delivery explains how it's done. So if you're actually going to physically deliver something, it tells you where and what grade and so on. And these things called mandatory settled contracts, they're cash. Of course, cash ones are for cash. Right, we'll end at that point, and we'll come back and we'll deal with how they close out tomorrow. So if you want to ask any questions, be around for a while. Otherwise, we'll see you tomorrow, and we'll deal with how they close their positions out.